So compared to accrue method, so exactly same situation, okay? You perform your job on December 20th. You send out the bill on 22nd, and you expect paid by the end. However, for any reason, this client delay the payment. If you want accrual method, okay, let me put it this way. Generally speaking, for business, okay, for corporation, for business, okay, usually you use accrue method, or even the law require you to use accrue method. If you want accrue method, taxpayer, even though you receive payment next year, you need to report income this year. So that is a major difference between, just give one example, major difference between cash method and accrue method. Clear? So this is another topic about by Henry. Oh, let me give you another example, okay, say cash method. Very interesting. Let's go back to the first example. You are cash method and also you are calendar year. Okay. You perform the job this year, send out the bill this year, and the check coming in your office on the 31st. And then when you receive the check, you don't even bother to open it. You just leave it on the desk. And when you come back to your office next year, January 3rd or 4th, you open out, then you deposit next year. Do you need to report income this year?
Yes.
Yes. Yes. You don't open the envelope, doesn't mean you don't have income.
Right.
As long as the check is on your desk, you say, I don't bother it, I just want to delay it. No, the law says you need to.
What if the check's in the mail
Right, because this is under your control.
What if the check's in the mail postmarked?
Yes. Even the check postmark. Okay, by the way, we use the method as a delivery, under your control. If the check's still on the way, use payment on the way.
Yeah.
Payment on the way is not your income.
Okay.
Only within your control, within your ability to. So, say I just ignore it. I just want to catch my plane. I want to go home. So as long as the check on your desk, so it doesn't matter this situation is your cash method or accrue method, you need to report this income.
Question.
Yes, go ahead.
So what about expense? If you book a ticket, pay the money now and take
Okay.
a travel next year.
Good example, okay. Good example. Everybody hear that? Henry just mentioned, how about expense, right? Yes, think about this. For tax planning, you want to report your expense as early as possible. Legally, okay. As income, legally, you want to report as late as possible. So eventually, there's a method you can report income late and report expenses early. But this is there is a very strict regulation. So for expense, by the way, you want to report it as early as possible. So that means under the accrue method is better than cash method. Understand? Accrue method means if this expense already happened, you can write it off, even though you have not paid off yet. But for cash method, only by the time you pay off, you cash out, then you can write it off.
So if you use cash method, but you use credit card, you pay already, but you don't really
Yes.
pay.
Yes. If you are the cash method, you have your cash method, you didn't pay your check, you didn't pay your cash, you pay by your credit card, you can deduct it. Because you pay. You pay. However, when you pay back to your credit card company, you cannot deduct one more time, right? You can only deduct one time. That's when you pay your expense by a credit card. So there's another method to delay your actual payment. Because actual payment probably is 20 days late. So it makes sense as a cash method, you use credit card to pay off your expense. Yes?
I have one question. For example, my broker get the payment from company like
Yes.
end of December.
Yes.
And he gave me like in the January.
Yes.
So he want to deduct tax. So he gave me a 1099. So what should I do? Can I just
Okay.
ignore the
So-
1099?
So for the cash method taxpayer, okay, whoever paid you that time, they deduct the same year.
Yeah, but I received January.
right?
Next year.
So you report year after.
I report year after.
Yeah.
Okay.
So let me repeat Jiro's questions. You are the cash method, okay, and you have something performed already, okay. So say for example in December, if your broker or your payer you reach agreement, say, well, it's only like 10 days left. How about I don't want to receive this year? You hold a check or you don't pay me till next year, okay. Then you may be qualified this income for next year, not for this year. Okay. However, okay, there is one, let me see, probably it's not here. Probably it's not, it's in chapter 2 or chapter 1. So let me answer your questions, okay. You may be okay, because you as a receiver have you have agreement with the people pay you. We both agree, okay. My December check, because it's not wage, it's my commission. My December check, you hold it up for like 10 days. You pay me next January, so only like a 10 days difference. However, I don't have to report income for this year. So you don't receive 1099, by the way. Your broker cannot send you
The
1099
broker
because
want to deduct his tax, so
Cannot.
he want to
Cannot.
issue.
cannot. So if you get benefit, your broker suffer.
Oh,
Your broker need to report his or her expense next year. So one people benefit, one people get suffer. So you cannot get both benefit.
Excuse me.
Yes, go
But
ahead.
he will, the income the broker gets, so will be 2010's income,
Yes,
right? But the
yes.
expense, he need to deduct
Yes.
it next year, right?
Yes, yes, because broker receive earlier. So again, you get benefit, your broker get suffer. Anyway, this is a good point for tax year, okay, or cash method. Those two issues are separate issues, but usually come in at the same time. Usually, when you set up your new company, or you set up your new accounting system, you choose your method already. So the first year you set up a business, you choose your as the say accrue method, and probably combine with fiscal year. Not necessary, okay. You could be accrue method, but you are calendar year, could be, right? Or you are cash method, but I'm fiscal year. Understand? So we have two topics already, okay? So don't fight, okay? Each one of you will get a chance, okay? Oh, number 90, page 90, but not necessary to the same page, okay? There's called assignment. What's the assignment? What's the assignment? You are the people who perform the job. You are the person who perform the job. And you are entitled to get paid. However, you have agreement with the people pay your money and say, don't pay to me, pay to my mom. I have too much income. I don't want to accumulate too much income because my tax rate is too high. And pay to my daughter. Okay, this is called assignment. Does it work? No, it doesn't work. Of course not. So let me repeat my questions, okay? If you are the people, you perform the job, and also legally you are entitled to get paid, and you just say, wow, my tax rate is too high, so pay to somebody else. To any third party, it does not work, okay? The issue probably is how does IRS audit? This is not the issue, okay? Maybe you can get it wrong. Maybe you're lucky.
It works
or
until
unlucky,
you get
okay?
caught.
You'll be right, but you can get caught, okay, by the way, alright? So assignment doesn't work. Just let you know, assignment doesn't work. Same thing as trading. Same thing as trading. Say, well, you are the international student. For example, you are international student. You come to here, study, and you want to rent a room. Say you are supposed to pay, say, $500, $600 per month. So you are supposed to pay. However, you trade. You see, how about I tutoring landlord's boy or girl after school?
yeah.
I have tutoring. I teach her or your boy how to learn the math, right? And you say, okay, this value is also $500. So we just offset. You don't pay me, I don't pay you. Yes, in our regular life it may work because you don't receive anything, and your landlord also did not receive anything. So maybe on the book there's no any evidence to prove. But if IRS come into audit, each one owed tax. So if you trade something, eventually you did not receive anything, still deemed as income. So be careful, okay, very careful.
Is that the concept of imputed income or
Something like
imputed
that.
benefit?
Something like that, imputed, right? Imputed mean actually you did not, it doesn't happen, but it be deemed as whatever. So it's called imputed. Yeah. So just keep this in your mind, okay? You may get it wrong, but you know that is counted as income. Right? Okay, we have another one, the number one exclusion right now. That is called interest on state or local bonds. So far this is our first exemption or exclusion. Okay. For those people who come in late, because I read the Form 1040. Okay, if you still have 1040 form with you, there's on the number I'm looking on the 2010. Okay, 2010. That is on 9 number. Eight, small letter B.
Which one?
Okay. Form 1040,
Body with
line number 9, small letter B, 9B.
qualified.
Did you see? I'm sorry, 8B, okay. 8B. Did you see tax exempt interest? Yeah, that's here. Okay. So what it is, if you purchased the bond which is issued from the state, or from county, or even from school district, okay, usually interest rate is a little bit higher than the CD, usually, okay. And on the top of that, this interest is tax-free. Because this is for the policy issue, government, especially federal government, would like to encourage people to invest your money on the local. Because when state government issue bond, they need money. They need money to do, say, school, to run school, to, say, construct a new airport, highway, that kind of thing. So this for policy. So far this is the first exclusion example. Okay, it is income. Interest, of course, is income. But if this interest is generated from state or local, tax-free. But be careful, okay? Be careful. If your interest is generated from federal bond, wow, you pay tax. How interesting, okay? How interesting. I don't know. Probably federal government doesn't want to compete with state. That's what I get. If you have money, $100, federal government encourage you to purchase state bond instead of federal bond. That's what I get. Okay, so this is the number one exclusion we learned so far. Oh, by the way, how many pages were off between the old book with the new book? Because this is on my page 91.
Interest income 104.
Oh, for 10 pages off. Okay, that means you pay. You know,
An extra 10
you
days.
get what you pay. You pay more money, or you get more pages.
You want a date over?
Okay, I will skip to a few pages. Page 95. Page 95. My page 95. Dividend. Dividend. If you cross-reference to 1040, that is on the line number 9. Line number 9. Small letter A and B. Dividend, of course, is income. No problem. Okay. So this issue reflects back to the C corporation we talked about 2 weeks ago. Remember that? So, by the way, for those of you who are going to take my financial accounting next semester, we will talk about dividend. But but that's the focus on accounting. Focus on accounting. Okay. So dividend is generated from corporation, right? For those of you who took my financial accounting, you know, if you prepare the bookkeeping for the corporation, for corporation you have a gross revenue, same thing, you deduct the expense, then you have revenue or net income before tax. Before tax. And if this company is a C corporation, then you pay your corporate income tax. You pay off. Okay. Then you have your income after tax. And from this number, you accumulate this number if you have a positive income, by the way. You have the net income after tax. You transfer this number to your accumulate, okay? Accumulate capital. This capital means is not contributed by the shareholder. It's the profit, the net profit generated by your business. So you transfer this net income after tax to the accumulate. Okay. Then from there, your company made a decision. The decision is made by the board of directors. Made a decision, say whether or not your company distribute dividend to the shareholder. So if the answer is yes, and as a shareholder you receive money, okay, from this corporation, you receive whatsoever, then you need to report as income here, and subject to your personal income. Okay, got it? Okay. By the way, I think it's nonsense, because if you how many of you invest in stock? You know that when you receive 5 pennies, right? Your stock price drop on the same day. So I think this is nonsense. The IRS just want to charge you something, okay? Because eventually, financially, you did not get anything. You received money, but your stock value dropped, same amount, and you pay for it. I think this is nonsense, but this is a rule. This is a rule. So this is called double tax, because corporation pay tax, its own tax already. When you receive it, you pay another tax. Hold on. One more issue here. Luckily, compared to say 10 years ago, your dividend income is subject to same rate as capital gain. So it's lower. Because I think that is the compromise between those two parties. Okay. So luckily, even though it's double tax, when you receive it as an individual, as a shareholder, you pay for your individual income tax. And also, if this shareholder is corporation, understand? It's not individual. Okay? If this shareholder is corporation, that means you are the parent company. You invest in another company, and this, say, company pay parent company dividend under general rule. Corporation receive dividend from another corporation, general rule, tax-free. Generally speaking, you understand? Because if parent company pay income tax again, then parent company pay the dividend to its shareholder will become triple tax. Otherwise, more and more, right? So if this shareholder is corporation, when corporation receive dividend from another corporation, generally speaking, that is tax-free. But we are talking about 1040 is individual. As individual, okay, we receive dividend from your corporation, from your invested company. It is your income subject to income tax. However, luckily, you pay capital gain rate. Yes.